What's up, guys? CPI day expectations is 3.1%. Do we go? Do we come in higher, in line, or lower? Do the markets go up, down, flat? See, we're gonna put a poll here. About 30 minutes until the data comes out.
Right away, just like we do every single day, with a quick check on where things stand as we head into the cash open, and a look at some of the overnight price activity as it oftentimes sets the tone for us here in the U.S. We saw a move up in the yen weighing on the Nikkei, and well, more economic support from Beijing giving Hang Seng a bit of a boost. In Europe, I saw, well, Euro Stock 600 higher for its fourth session in a row. Taking a look at the DAX and the FTSE gaining as they head into their late day trade. Look at the UK FTSE, the 100, the benchmark up almost 1.5%. And, well, this has U.S. indices on the move higher as well. A continuation of the pattern we've been seeing, the bid into the data due out today at the bottom of the hour. The inflation number, CPI's Consumer Price Index, a very closely watched data point here, headed our way in about 30 minutes. All four of the majors enjoying gains, led by the Russell, which has been the trend, right? Small caps have been leading. Look at this move, convincingly above 1900 this morning. They're up about 0.6%. All four of the majors in positive territory. Checking in on some of the other top traded products and a couple of the products we're going to be talking a lot about here today on the show. All a reflection of that weakening U.S. dollar, down to, well, 101 this week. Here you can see lower again today as we head into the cash open this morning. Greenback down 0.2%. Gold's benefited. It's up 0.1% here today, hanging out around 1940. Crude's also been on the move higher with the weakening dollar. It's hanging out around 75 after some comments from the IEA, their short-term energy report ahead of the OPEC monthly report, up 0.4% here. And look at the VIX, kind of comfortable around this 15 level. It's down about 1.5% as we head into the cash open again.
SPY is ripping pre-market right now.
Expect to see. Let's get into the three things this morning to keep an eye on. That's inflation data here in the U.S. due out at the bottom of the hour. Consumer Price Index expected to show signs of price pressures, which are easing further. The headline down from 4% to 3.1%. Speaking of easing further, the U.S. dollar has been, well, and continues to be on the decline as inflation concerns subside. The greenback to 101 with foreign currencies like the euro, the yen, the pound, all strong versus the U.S. dollar. Sterling to April 2022 levels. Lastly, the weaker dollar has an impact on crude and gold prices, both higher this week. That inverse correlation alive and well, as we oftentimes see the U.S. dollar weakness supportive of commodities, metals, energies, and grains, oftentimes, again, bolstered by that weaker dollar. Let's get into some charts, because we've also seen large caps which have benefited from the weaker dollar, and that's where I want to jump off into our more granular look at price activity, and we'll work our way to the bigger picture concepts here in just a second. But first and foremost, the 5-minute candles, the run-up we've seen off the lows Monday in the Dow, 33,800. Look at this, up to 34,500 and change. We're talking about 700 ticks to the upside in just a matter of 2 days. This all ahead of a very closely watched CPI number. This is a pretty good reflection of how investors are exhibiting signs of optimism heading into some of this very influential releases here this week. overnight. Let's move away from the Dow, the 5-minute candles, taking a look at the S&Ps. We've been holding this upper level for a while, right? Here you can see the year high prints 44.98 into the end of June. To begin the month of July, a bit of a chop trade around 44.50, 44.60, but zero rejection of this upper level is the best way of looking at it, I think. These are 60-minute candles here. A look at the run-up we saw throughout the month of June and how we're holding throughout the first half of the month of July, these upper levels. All right, another step back shows where we are relative to the 200-day moving average. You can see the S&Ps holding above that longer dated, and again, that consolidation area that's forming. I also want to point to what we're seeing here as we look to now, well, here you can see the Dow on the right, the large caps, the ES on the left, and both holding above that very closely watched level, and definitely something to keep an eye on here. Now, we've also been watching, as I mentioned, the US dollar, which has weakened, and interestingly enough, this has come as rates which have been testing those March levels, so quite the divergence between the US dollar and yields. This is the 10-year. I think you can chalk up some of that weakening US dollar. Well, here we saw it bolster crude. We saw it bolster gold, as I mentioned, but chalk it up to some of the strength we've seen in the British pound there, as well as some of the strength we've seen in the yen. Okay, it's at this time of the show I'd like to bring in Mr. Kevin Hinks joining us here, senior equities contributor on the TD Ameritrade Network, taking a look at and a deeper dive into some of the top stories. Kevin, good morning to you. Let's begin with CPI. That's the big focal point for the week, right?
Yes, good morning, Ben. I believe a lot of the catalyst for what's traded already this week and what will trade the rest of the week is based on CPI.
Okay.
A lot of whispers, a lot of anticipation, a lot of expectations.
For a weak number.
For a weak number. And Ben, what do you correlate that to? Well, you can connect the dots to the weaker dollar because of that,
yes.
Right? If you're looking for a reason why the dollar's lower, remember, it is a hawkish contest in currencies. To put it in the most simple, talk to me like I'm a 6-year-old level. Think about if it's a hawkish contest and our inflation is coming down like the whispers say, we don't know yet, but the whispers say, then the UK, Eurozone, may have to be more hawkish than us and our dollar would come down. That is an explanation for why the dollar has been soft today. And then you look at what its effects are, right? The dollar affects so many commodities like gold, like metals, like grains and crude and other things, but it's all about the dollar. But why the dollar might have something to do with the expectations of CPI this morning.
You always say get the dollar right, you're going to get these other markets right that we look at here, and I agree, everything seems so intertwined right now, all of this in anticipation of the number, the weakening dollar. I just pointed to how I guess one could argue it's helping lift large caps, the move up we saw on the Dow.
Well, lower U.S. dollar, I know it sounds counterintuitive to say the lower dollar is good.
Yeah.
But a lower dollar makes our goods and services for U.S. multinationals cheaper to foreign buyers.
Yeah.
It's just that simple. So, yes, U.S. multinationals, and by the way, Ben, 27 of the 30 Dow stocks are multinationals. So if you look at the Dow Industrial Average, they're going to do better during that period.
Well, the reason I bring this up is because there was a lot of concern about the breadth of this rally.
Yep.
It was all focused on these 7 tech individual names. Now we're starting to see a little bit more broad base. It's not just large caps, but also small caps also.
Well, you have seen some rotation, and it may have to do with what the NASDAQ has planned. We're going to find out on the 14th exactly what's happening.
You talked about this yesterday.
And then when they do it right. And that was a big focal point because you saw it in Monday's trade when this news broke. They sold the Magnificent 7 names and bought the other names. Now, it's not sure. We're not sure what the overall effect will be on the NASDAQ because I don't know there'll be net selling of total stocks, but it looks like they're rebalancing the NASDAQ 100, and that could cause some issues with these stocks. If you look on a heat map, Ben, of the NASDAQ right now on the Thinkorswim platform, those 7 stocks, they dominate the landscape of that heat map. It's really quite incredible how the other 93 stocks are pushed over into one corner on that heat map. That shows the market cap of those names. And so that's what I think the NASDAQ is trying to adjust.
I want to continue this dollar discussion here, but before we do, I want to look at some of the reasons we're seeing weakness in the U.S. dollar. Again, I mentioned at the top of the show the British pound. I mentioned a bit of a divergence between yields in the U.S. dollar, but here is sterling. Again, back to April of 2022 levels. I mean, we've seen strength there. Also, as I just kind of move my way through here and point to some other culprits, you've got the Swiss franc. Look at this run-up we've seen back to 115 or just shy there thereof. Look what's
Let's
going
see
on
what
in peso. I mean, strength there
Bloomberg
as well.
is talking
and
about
pushing
real
those
quick.
to the
or in 2 years' time.
Yeah.
So I think there is an I would be long duration bonds. I'd still say high quality because of the risk of some economic turmoil here, but I'd stay long duration because there is a play there. And then for equities overall, value does look very cheap relative to growth right now. And notwithstanding the fact that growth seems to like lower rates, I think that the valuation gap is so dramatic there that I would be a little overweight value, a little overweight international too. I'm really impressed by the fact that the dollar is coming down on a 4% 10-year Treasury yield, and that tells me that when rates go lower in the U.S., we could have a significant dollar decline.
Well,
I think that's a big positive for international.
8 ways to go here, David Kelly, but let's just keep it simple. You're looking for a demonstrative weak dollar move?
Yes, I mean over the next few years,
Let's go to CNBC.
that's very likely.
I suspect these may become bigger stories as the second half of the year plays forward.
In terms of the rates picture, though, we did cross those key thresholds of 5% on the 2-year and 4% on the 10-year, and we gave them up. So what makes you think they move higher?
Well, let's just think about the paradox here for a moment of it was a year ago to the day we printed 9 on CPI. And here we are in 25 minutes about to print 3. What have yields done over that 12-month period? They're actually higher. Right? So you have 600 basis points of headline CPI lower, and yields have gone 3.25 back to 4. Our big call this year has been yields will be right-hand sticky, and I still think they're very right-hand sticky here. You know, pushing up through 385, 390 was a very big breakout on 10. I think we're consolidating these here, but ultimately 4.25, maybe 440, 450 is where we like 10s here. But also just think about the paradox here of, when did the energy sector peak last year? It peaked when CPI printed 9. What's happened the last few weeks here? Energy stocks showing some signs of life. So this market right now is full of all these great paradoxes. And I think yields and energy are both coming to life here. Very important implications for second half.
Yeah. Particularly for services, right, on oil?
Absolutely.
Yeah.
If you look at the service expiration ratio, the service names have really turned. And just look at the names. Schlumberger, really important breakout over the last several days. Halliburton, Baker Hughes, Champion. So this move to services, I think, is important. And quietly, I mean, they've had Brent oil down to $70 6 times over the last 4 or 5 months. They can't kill it. They can't kill it. Brent back above the 50-day, I think, is important here.
All those technical things. I don't know whether you watched, but Jeff Curry yesterday, I mean, he tells me things about just commodities in general, just underinvestment across the board. I don't know what that means, but we're going to be using a lot of this stuff for years and years and years, and you just don't flip a switch and replace it.
I think, Joe, in this business, it's so easy to lose the plot amid the noise of the daily data, right? The last 2 years, it really looked like the world was changing with rates and with energy and commodities. And then you look at the first 6 months of 2023, and everything suddenly goes back to the old way of tech. And I'd be careful with that. I think when you look at what's happened the last 2 years, I mean, we have turned a 40-year cycle in bond yields. That is a very meaningful move. And I think the leadership implications of this over the next number of years are still to be found out. One of the things I really like here, and we've talked a lot about this, is the industrials. I mean, these are names that remind me of what tech looked like in 2012, 2013.
Yeah, record high yesterday. You see more room to run to the upside.
I
Chris,
do.
good to see you. Thank
Good
you.
seeing
Chris
you.
Marone.
All right, coming up, the inflation data will be breaking at 8:30. We'll watch a market reaction. It's Eastern time, obviously. Next, though, Wyoming Senator Cynthia, in this case, it's Lummis, not like Dr. Loomis. And she outlines her beefed up cryptocurrency bill and talks about
18 minutes, guys.
Chris?
Just 18 minutes.
About how to prevent another FTX. Stay tuned. You're watching Squawk Box.
Payrolls, it's going to evaporate at some point.
We'll see what we get.
Very lonely.
In just a moment. CPI just around the corner. If you are just tuning into the program, welcome. The S&P 500 positive by 0.25%. Coming up, former New York Fed President Bill Dudley ahead of the US CPI data.
Yeah.
Looking forward to that. Tom, I know you've been itching to talk about this all morning. Not Bill Dudley, not CPI. Mr.
No,
Ricardo.
surveillance is
Mr. Ricardo has got a seat. Alpha Tauri.
What we've learned with our
The rumors are that that's going to crack to the downside. Let's watch for that. Used
Okay,
car
well, that
prices.
could be pivotal in some ways here, especially when you're looking at expectations for a 0.1% decline on the month-over-month basis for that core number. I guess if we see an increase there, the year-over-year will play as well as the headline at that point. But Kevin, we will keep an eye on the core. We'll keep an eye on some of the other focal points here that we've been discussing here. We'll continue to watch, and not only the data, but also market reaction too. We're going to take a quick break. Thanks to Kevin for a look at the top stories this morning. When we come back, commodities with Brian Hoops. He's president of Midwest Market Solutions. Stay right where you are. We're talking more futures in 2 minutes.
Whether you're an experienced investor or just getting started,
Podium.
And they got
Let's
a
hope he
pick.
gets some decent races.
and he's going against Perez.
Talk over me.
No, but John, so he's going against Perez.
Okay.
What happens?
No, if he has
Did
a
I do
good
well there?
season,
Was that good?
and you're going to have to define what success would look like at Alpha Tauri, but if he manages to impress, then you'd wonder if Checo's seat at Red Bull was under threat. Given the difference between Max and Sergio
Yeah, well,
Perez
Max
right
is
now.
Max.
Well, Max is phenomenal, but he seems to be so
Who do
much
we have to
better
have
in
on
that
next
car
to get him a job?
than Checo.
You know?
Who would you like to catch up with
I
in
don't
the
know.
world of sport?
Piastri did well.
We can talk
you
to some free agents in the football world, Tom. It is summer.
Yeah.
We can have a conversation with them.
What's
try and get him a
Loris
job.
doing? The goalie for Tots.
Talk that he might leave.
Yeah.
This is great stuff.
It's great stuff.
Thanks.
So this is a chart of the CPI. It's the Fred St. Louis Fed website. And this shows inflation peaked in June 2022 when it was at 8.9%. It's been going down since then. So, do we get an uptick today, or do we keep going down? We'll see.
Yeah. Senator Lummis joins us now with more details. The SEC Senator, to crypto fans, that's like, well, it's letters, but it's kind of a dirty word. You getting anywhere at all? I mean, look what's changed since last time. BlackRock, Fidelity, who else? Charles Schwab. I mean, these are brand name companies. Why is Congress, they're so behind on what the private sector is trying to do right now? Let's go.
Let's go is right. We need a regulatory framework that integrates crypto assets into our economy and in a way that ensures consumer protection. So we need to make sure that we have exchanges that are registered with the CFTC. We need to make sure that illicit finance is addressed, that we have adequate penalties, that we make sure that the assets and reserves behind crypto are sound. These are all additional safeguards that we have in this bill. And it's definitely time to move ahead now that we see so much more integration of digital assets in our economy.
It kind of doesn't make sense when you think about some of the things that have happened, FTX, for example, or take your pick. And so the foes of crypto that maybe are preventing your bill or similar bills from going through, you would think that their intention is to protect investors, and yet the lack of doing anything and sitting on their hands is what actually ends up actually hurting investors. So have they connected the dots to that yet?
Well, we're going to help them connect the dots, because you're absolutely right. That is what's happening. When we have companies that are incorporated offshore, not having adequate consumer protections, and being able to function, as Gary Gensler likes to call it, in the Wild West. We're making sure that consumers can get burned, and our bill would prevent customers from getting burned in the way they can be burned now. So I'm hopeful that people will finally recognize that this legislation is not only needed to protect consumers, but so there are rules of the road for these companies. Right now, they're being governed by enforcement actions at the SEC rather than being told, here's what you need to comply with, here's the rules of the road if you're going to integrate digital assets into your economic models and into your business models.
Do you speak to Chair Gensler? And I'm wondering, can he say, well, since we don't have any framework from Congress, I'm left with no other alternative than to do this? Or do you think that his, I don't know what you'd call it, resistance to maybe legitimizing cryptocurrency or Bitcoin or whatever, is that part of what the problem is with Congress? Can he point the finger at Congress, or is he part of the problem that's preventing Congress from doing anything?
Well, for a while, he was concerned about some of the definitions that we used in the bill, but we have adopted some of the SEC's recommendations, so it's more clear about what is a security, what is a commodity, about how to deal with ancillary assets, those that don't fit neatly within one of those categories. So we create an authority within the bill that includes people both at the CFTC and the SEC, as well as other agencies that can help sort this out. So it's problematic that the SEC is using enforcement actions instead of telling companies in advance what compliance will be required. I think both Congress in its reticence and the SEC in its lack of proactive guidance to companies are both responsible for some of the erratic regulatory framework that we have now.
Yeah, we had the Coinbase CEO on who said, and there were risk factors in it when the SEC did sign off on the IPO. I mean, all the risks were outlined, but it still almost looked like the goalposts were moved or the rug was pulled out from underneath that company. And that's not a good, that doesn't help instill confidence in the agency or in the whole sector. So I don't know how to do this. Can we talk about TikTok? I mean, so you and Gillibrand, so that's bipartisan. And then you've also got TikTok. This bill, you've got senators or Republicans and Democrats on here as well. And I don't know, when you hear about banning something, that raises, no matter who you are, that raises sort of, in the private sector, it's like, do we really want to do that? So this would maybe harness things with TikTok, but not ban it outright.
Correct. So what we want to do is make sure that the data of users of TikTok is protected from surveillance by the Chinese Communist Party. And the way we're doing that is to provide for a registration. So there is a wall between people's private data and the opportunity to use it as a mechanism of surveillance.
Do you, can you give me a timeline on a spot Bitcoin ETF? When do you think that's going to happen in your, that might change things. That might give, I don't know, give some cover to whatever's holding up your bills that we try to do again and again. That might give some cover to that. Might happen, right, if there were a spot ETF. Will that be signed off on anytime soon? I mean, you've got big names, BlackRock, involved there.
Exactly. So you have these companies that a couple years ago were complaining about how Bitcoin and digital assets are used for illicit finance and they're fraudulent. And now, of course, they want to incorporate them into their business models. So for one thing, I think that's recognition that these assets can be a store of value and eventually a means of exchange, and they want to add them to their offerings. I hope that it's going to come sooner rather than later. The futures market, the spot market, and the CFTC's involvement in integrating Bitcoin specifically, but other digital assets as well, should make for these companies to be able to have these offerings in a way that has adequate consumer protection, protects against illicit finance, and shows people that these assets are here to stay.
We'll see, Senator. Thank you. And we'll be watching. Let's see how far along we get this time.
Thanks, Joe.
Okay, you're welcome.
Coming up, the June CPI inflation report. We'll get the data and the instant market reaction, then talk with former Fed Vice Chairman Roger Ferguson about how the central bank is likely to view that number. Stay tuned. You're watching Squawk Box on CNBC.
Now to a higher inflation or a lesser inflation, a greater disinflation?
Well, I think there's two positives and one negative. The positive is that goods prices are coming down, partly because people have changed their demand composition. During the pandemic, they bought a lot of goods and not so much services. Now they're buying services, not so much goods. And so you see a lot of weakness in goods prices. Number two, you're seeing the fact that the housing price inflation is going to start to come down with a lagged effect, but we're not seeing any progress on the services side outside of housing, and we're not seeing any progress on the labor market. So I think it's still a mixed picture. The good news is the Federal Reserve has gotten now to a restrictive monetary policy. I don't think it's that restrictive, but it's restrictive enough that it should slow the economy down. And probably the Fed has another 25 or 50 basis points of rate hikes to go. And if they do that and they hold that for a while, that should be sufficient to do the job on inflation.
What are you looking at when you talk about longer term? We're not going to be going back to the low inflation regime that we're in previously. And I see this at a time where increasing automation is driving efficiency and perhaps productivity in a number of different companies, for example, Chipotle, with avocados and new avocado cutter and peeler as they try to reduce the amount of time. And how does this factor into longer term paradigm?
Well, the interesting thing is the actual productivity numbers over the last year or two have been horrible. So we're actually not seeing the productivity improvement yet generated from things like artificial intelligence, and it could actually take quite a bit of time. There's a whole bunch of things that we do in the economy that aren't getting more efficient. You think about, hospital care, medical care. You think about home construction. Think about, our teachers becoming more productive in terms of how they're teaching their students. So there's a whole part of the economy where productivity gains are very hard to come by.
John, how do we get to avocados and avocado peelers there?
Bramo's reading.
It's actually relevant because
Dr. Dudley knew exactly what you were talking about.
Yes, because a lot of fast food companies have been automating more, and Chipotle now has a collaborative robot dubbed Autocado that cores, cuts, and peels avocados before they're mashed.
I'd love one of those.
Amazon Prime, I could see it in the Bramo kitchen.
Did you do Prime yesterday?
No, I did not. I'm the only one in the country who has
Did you do Prime yesterday?
Dudley does Prime.
Okay.
Did you?
Yeah, I got some protein.
Protein?
Yeah.
With your almond milk?
Yeah. Good. Yeah, ready mixed. The ones I have in the morning. You know the ones, breakfast.
I do know what you're talking about.
Stocked up on breakfast. Bill's going to stick with us. CPI. Maybe. Mike McKee. Look, if you're on TV, you can see it. If you're watching this on radio, you can't. So Mike McKee in this romantic log-fired cabin scene, Tom,
20
in
miles
Idaho
from
at the
Jackson
Rocky
Hole.
Mountain Summit. I mean, what are we all doing wrong?
He owns the high ground. That's all I can say.
Just beautiful. Mike, you're going to join us, and thank you for taking some time to actually come on with us today. We appreciate it. We really do. CPI in about 4 minutes, Mike. What are you looking for?
Well, we're looking for a very good report this time, especially for headline numbers. But as Bill made the really good point that things are going to be transitory on the way down. We're not going to hold the same numbers. We also run into what's called base effects in economics. Because inflation rose so much in June last year because of energy, then it's going to look much better this year. And we're going to see probably a big drop in the headline number. But the Fed will be looking past that because they know it's going to be tougher the rest of the year. Inflation had come down on a month-over-month basis significantly after June. So don't put all your money on this being the turning point yet.
Mike, we were told that we had two important data points going into the July Fed meeting. That's 2 weeks away. We had payrolls last week. We've got CPI this morning. They're the two. Deutsche Bank and Jim Reed earlier today. Hike in July is pretty much nailed on. BMO's Ian Lingen said this yesterday. Quarter-point hike on July 26 is a foregone conclusion at this point. Mike, is there any reason to believe that the information we see in a couple of minutes' time could change that conversation?
I don't think so, for the reasons that I just mentioned. The Fed is going to be looking past a lot of those different one-off kind of changes. They're going to want to see consistent movement, and as Bill Dudley said, they're going to want to see services ex-shelter start to drop. And start to drop significantly. We have not seen a real change in core or services X since the beginning of the year, and that's what the Fed is looking for. So we'll get that rate increase in July.
1 minute.
The real question is the data between now and September. Does that make a difference to them?
Here we
in
go.
terms of that second move.
Mike McKee, stand by in just a moment. About 2 minutes from now, we get some CPI data for you. On to PPI tomorrow morning. Mike McKee's going to break that economic data for you. And then Bill Dudley, former New York Fed president, now Bloomberg opinion columnist, amongst other things, is going to weigh in and respond to that. The scores going into all of this, equity's actually a little firmer, positive on the S&P 500 by 0.2%. Yields going into this, Lisa, just backing away ever since that ADP report on Thursday. You had the information on Friday we learned from payroll. Since then, yields lower, yields lower.
People don't seem to think that disinflation is transitory, to use some of the language that we've been hearing. They're banking on it.
Wow. It's going to happen no matter what we do, if they still do it today.
Don't cast doubt. We're 40 seconds away.
Welcome back to Squawk Box on CNBC. We're just seconds away from June CPI. I'm expecting that they will go through it. The futures right now up 57 points. NASDAQ up 55, S&P up 11. Take a quick look at the 10-year, which continues, I don't know, yields down a little. That could change so quickly in about 19 seconds. We did have pretty good days, Monday and Tuesday. S&P's up, what we figure, it's up about 40 points out of Tom Lee's 100 that he was predicting. We're going to get an answer. Rick Santelli standing by at the CME in Chicago. He's going to just have a bunch of numbers and comparisons in about 2 seconds. Hey, Rick.
Yeah, that's absolutely true. Consumer Price Index for the month of June. We're expecting a headline number to be in the neighborhood of up 0.3, but I'm going to be paying most attention to the core at up 0.4, our last look, and I'll tell you why in a moment as we wait for these numbers to populate. And here we go. If you look at the headline, up 0.2%, up 0.2%. And that, of course, comps to the up 1/10 in the rearview mirror. It's a 1/10 lighter than expectations. Now, CPI core, ex food and energy, up 0.2, up 0.2. And that means it's not the fourth consecutive month up 0.4. And it also means it's not the seventh month in a row of 0.4 or higher. And that was a record going all the way back. The last time we had something along those lines was from October of 89 to April of 90, where it was 9 in a row. So we stopped that as well. And up 0.2 on the core is the lowest level going all the way back to February of 21, when it was only up 1/10. And if we look at year over year, up 3%. 4% in the rearview mirror. Well, 4% in the rearview mirror was the lowest level since March of 21. So when you see 3%, you have to go all the way back to March of 21 again, because that's where the comp drops from down to 2.6 is what we're comping to. And in the rearview mirror, 4%. And here's another one. If you look at ex food and energy, last month it was up 5.3. That was the lowest level since Nov of 2021. We breached 5% to 4.8. 4.8, and that remains at the lowest level since October of 21, when it was 4.6. We could see that interest rates have fallen about 3 basis points in tens from 393 to 390. We see that the pre-opening equity markets have rocketed higher. Dow futures up basically 200. And of course, we are going to monitor if there's any changes in Fed fund futures. I don't think so. At 10 o'clock Eastern, look for Bank of Canada to go a quarter point to 5%. Dollar index prior to this number, of course, was at a 2-month low. My guess is it's not rallying at this point, and we're all going to pay attention to the UAW. You know, wages are a big issue, as we learned last Friday, and UAW and strikes and minimum wages across the country. All of those things may be good for many people, but there's very little doubt that they also fuel some wage inflation. We need to pay very close attention to that. Joe, all yours.
So no change in, so Bookvar was on. He said they're going in July no matter what. No change in that probability?
Well, it's dropped a little bit, and it's slow moving right now in the futures, but we've gone from basically 88, 89% where it's been hovering for pretty much since the non-farm numbers. We lopped off a couple of percent to maybe 86%. And Joe, you know, I have cheeseburgers bet with Steve Leisman, and I really don't think they ought to go, but it's very hard for me to think that they're going to be dropping that 86% anytime soon. They seem to always like to make sure the market and the Federal Reserve voting panel are in sync, as they seem to be. I think the real issue is September. I don't think they'll go in September, and I think a year from September, they'll regret going in July.
So where should Fed funds be? What should we assume about core? It's in a downward trend, and then how much should we add on core to get to the Fed funds? Where should they be? Given what we just heard today, what's the number where they should feel comfortable with? Where, you know, if you don't have to put people out of work, it would be nice. If you don't have to put people,
target.
Yeah, it is. Okay. So, but approximately.
It's a moving target. So, you know, let's look at where CPI core has been, okay? So it peaked in what? June of 2022 at 9.1%. So it went 9.1, 85, 83, 82, 77, 71. And decent 22, it dropped under 7% to 6.5, then 6.4, 6%, 5%, 4.9, 4%, and now 3%. So we could see, I'm sorry, that wasn't core. That was year over year. If you look at core, that's been much stickier. It was 6.6% in September of last year, Joe. That was a high watermark back to 82. I'll do those too. So we've gone from 6.6 to 6.3, 6.0, 5.7, 5.6, 5.5. And the fly in the ointment was, if you remember, last February, this February of 23, we went from 5.5 to 5.6 in March. That uptick really made the markets nervous. Then 5.5, 5.3, and now 4.8. Why did I do all that? Because I think that over a year, over the next 12 months, we're going to get it down very close to the Fed's target, 2, maybe 2.5%. But I don't think it's going to get there in the next several plus months. And that's the rub. So when you ask me where Fed fund futures need to be, if they're taking the tact that they need to control it immediately and see the drop immediately, they're going to have to go 2 or 3 more, in my opinion, higher than they currently are. So another 75 basis points. Maybe they do 25, maybe they do 50. But the point is, it's coming down, as I referenced, by going over all those months. And I continue to think we're not going to only see the same type of progress, albeit more slowly on the year over year, but we're going to see it continue, and it's all going to occur higher for longer. I think Raphael Bostic has expressed some of those exact sentiments. I just don't think that the central bank believes that we're smart enough to understand that if they take that tack, they're not being aggressive enough in the here and now, and I think that's the issue.
Right. Right. All good points, Rick. Thanks. Stay with us. Let's bring in a few more voices to talk about this new data. Allison Schrager is a senior fellow at the Manhattan Institute. Betsy Stevenson is an economics professor at the University of Michigan and a former member of the President's Council of Economic Advisors. We also have our own senior markets commentator, Mike Santoli. I'll get to you in a second, Mike. Some interesting Bitcoin, gold, the dollar index. I mean, they're all like just quick moves. So this was a number worth paying attention to. Allison, Fed's going how many more times?
Well, I think it'll depend certainly on the next report. This was expected to be good. It was. But I think there's still reasons to be concerned, particularly that inflation's still high in services. And that suggests that this last 200 basis points might be a little stickier and a little bit more entrenched than what the fall might not continue to be as fast and as steady. So I think, potentially we might be going another 75, but we'll know more in the fall for sure.
Professor Stevenson, what do you make of this number? It's progress, but is it going to be uneven from here on?
Well, let me just say, I think another 75 would be a mistake. And what we're seeing in this number is that this is a game that requires patience. It is coming down. We got a little stuck on core, and I think everybody's a little nervous. I think if we had seen another month of 0.4, I would have been very worried. I'd be saying something very different. But we're seeing it come down. That 0.2 is exactly the number we needed to see to have, year over year get down under 5%. The thing the Fed has to do is it's made a promise to raise rates at least one more time. So it's going to have to do that because it sort of made that promise. It's built those expectations into the market. And then I think they really need to be pointing out how inflation does have to come down slowly and it requires patience. The rate increases they've already done are still working through the system. That's why we see the number we're seeing today. And they're going to have to, give it time to continue to work through the system. Look at the jobs report we saw last week. We see a labor market that is slowing, not crashing, but slowing. We see inflation that is slowing. This is exactly what a soft landing looks like.
Wow. Mike Santoli, on the 10-year and the 2-year, are we now below where we were last Wednesday before that ADP report? Or have we given back all those? It looked like yields are finally getting to believe the Fed. Now we're back below where now they're challenging the Fed again.
Well, I think they're believing the Fed in terms of the next, 100 feet of road right ahead of us, the July meeting. I think that's pretty well priced at this point. The Fed has been saying, I think they've been trying to send the message, Powell has, that they're willing to allow just time at these yield levels to do some of the work for it. And one of the reasons stocks have been able to do well this year, the whole equation has been, is inflation going to come down faster than the economy deteriorates or demand slows? And that's been the case. Inflation has been more benign than the concerns about growth have really taken hold. And so that's a comfortable spot to be in. And then when you're talking about a meeting in a couple of weeks for the Fed and then nothing in August, you have a September meeting, that's very much open. I think what you're seeing the market say is a better chance that the Fed's just about done. And by the way, the Fed hasn't been the main story for a while. The market's been acting as if inflation was mostly a 2022 problem. We're 1 year past that peak stagflation panic we got in markets with the 9% CPI, people assuming that recession was here. And we've been, I think, essentially making our peace with the current yield levels. Who knows if that continues? I do think the market took a fair bit of credit for a pretty good inflation print today before we got it. There was a lot of confidence building that it was going to be a downside surprise. Question about whether we can persist around these levels of CPI.
I mean, the drop in yields, Mike, is giving a free pass, at least for now, to the tech trade after a torrid first half rally. I mean, we questioned whether or not they can run, and we're seeing the pre-market, in reaction at least, some fairly big gains, particularly among the higher multiple stocks like an NVIDIA and a Tesla. For sure. Look, the tight connection we saw last year, though, between mega cap tech and the direction of yields was really been broken this year. It's just yields has not been the main mover here. It's been confidence in, profit margin defensibility. It's been about AI. It's been about just buying the big, obvious stocks that have great franchises. I do think what's most significant about the recent market action, though, is it has broadened out a fair bit. You have 40% of all S&P stocks are up 10% year to date. The equal weight of Russell 1000 is up 6% this year. It's not just been 7 stocks. And industrials and consumer cyclicals and transports have been outperforming. Credit looks okay. In other words, the market for now is betting we have something like a period where the soft landing seems plausible, whether we ultimately, get that or not.
Allison, I ask this all the time, being at the Manhattan Institute. Could it be this easy? Can the Fed really nail it after 10 years of zero and all kinds of mistakes, according to some people? Can they orchestrate this and stick the landing? Can that happen?
It could. I mean, I guess I'm just superstitious, and I have actually been pro soft landing until last week. And the fact that everyone now expects it makes me think that now it won't happen because we've jinxed it. So, I mean, I guess I'm still cautiously optimistic, and like sort of, I said, let's just wait and see if, as I said, what happens to wages and the parts of inflation that are a little bit harder to vanquish before we declare victory.
Same question, Betsy.
I think they can. I think they've been showing that they can. You've seen the Fed oscillate between early in the pandemic. What they really cared about was the labor market, and they let inflation get a little bit out of control. And now they've really pulled the hammer down on inflation. I think that they're getting the mix right. I think it's going to take a little bit of time. Nobody wants to see inflation come crashing down overnight. I think what we want to see is this nice, steady decrease. And as long as we continue to see that, I think the Fed's in good shape. And look, we're already in an inflation range where, things are getting better for families. Like we saw food at home didn't increase at all last month. And that's really important for everyday people, that the price of their food's not going up.
That's true. All right, I'll end where we started. Just quickly, Rick, so do you think they're not, if they do go another 25, is that overshooting, or is it close enough for government work? What do you think? Will you be happy with that? Will you be satisfied?
Oh, yeah, I think it's close enough for government work, Joe. And if you'd ask me if we're going to have a soft landing, I'd say I think it's going to be great. But just like inflation being slow, the biggest problem we have is going to be commercial real estate. That's going to be the price that we pay. There's your hard landing, but it's going to take years before we really know that fact.
Yeah, and nobody coming back to work and everything else. So, yeah, commercial real estate is challenging. All right, thanks for a lot of reasons. Like talking about how tough Hollywood is. I hadn't even figured in AI for these poor writers.
Yeah.
I mean, good God.
I mean, did you ever imagine what they would do, what somebody would do with your likeness? I mean, if they own your likeness and they own pictures of you, they own the footage, the content that you create, what else could they do with it? Because that's what contracts do.
Got it. Anyway, Allison, Betsy, Rick, and Mike.
Just tested 31,000.
Big moves. We'll see if they hold up
yeah,
there.
Exactly.
Yeah. Coming up, former Fed Vice Chairman Roger Ferguson will help us understand what the new CPI number means for central bankers weighing more rate hikes. Stay tuned. Squawk Box will be right back.
But I think nominal GDP growth is likely to remain pretty healthy until you get into 2025 and inflation maybe is settled down to around 2%.
If you're joining us right now on radio and on
Everything is
television
ripping right
nationally,
now.
we are commercial-free through the rest of this hour. Lisa Abramowitz and Tom King, John Farrell as well here with a shock inflation report. And Lisa, as I sum it up with futures up 30, that's SP futures, Dow futures up 172 after a buoyant Tuesday. NASDAQ futures were giving me up 1% moments ago. And there's a little bit of an ebbing and flowing here, but certainly the shock is a celebration of disinflation.
Yeah, in the currency space in particular, you're seeing the Swiss franc right now at the strongest versus the dollar going back to 2015. You can see pretty significant and strong moves across the board in the two-year space, yields coming in dramatically as people start to game out what it looks like if the Fed rate hike this month is the last in the cycle. We're speaking with Michael Gapin of Bank of America.
Got to keep
Michael,
the chip stocks on
if this data does continue,
watch.
that does seem
LRCX,
like a likely case. I just want to get a sense from you on the real wages point. How much does that make it difficult to see ongoing disinflation, that real wages are rising at an accelerated pace?
This stock's good rip.
I think it makes it difficult if you're a policymaker and you're thinking, I need to get demand and supply into better balance. But what I'm seeing is a consumer that continues to want to spend and is getting significant increases in real wages.
Getting a small pullback
so
here.
it may be hard for them to, again, make that conclusion that we're on a path back to 2. It's about confidence in that outlook. So you need a combination then of actual evidence on the ground that, where is the new trend in inflation? For example, is it 0.2 or is this a one-off and we go back to a 0.3? And 0.3s are more the run rate. Or, you need a collection of evidence on what the new new run rate is, plus where spending and real wage data evolve. Again, this may ultimately be about the timing of cuts and how quickly those cuts come in. And the near-term path for the Fed may be more about these prints on inflation. Inflation may dominate whether the Fed hikes beyond July.
So
But
SPY is currently at a
when they're back to
new
a
52-week high.
on the other side could very much be about that labor
Now the
market.
challenge is,
Counter-programming is
will it
Richmond Fed
open
President Tom Barkin, who's
where
speaking
it
at a
is right
separate
now?
event that came out in tandem with the CPI data,
So is
saying that the U.S.
QQQ.
inflation rate is still too high, that the Fed has been moving aggressively as it could against inflation, and talking about the longer-term view. Michael, if we do see the rate hike that we get this month as the last in the rate hiking cycle, how long do you expect rates in the U.S. to remain about 5.3%, give or take, for
if we're not going up another 100 basis points, that's what moves these tech stocks, right? If
I mean,
it's safe,
it certainly
is it safe?
helps. It helps
Yeah,
if
is it
rates
safe?
are
Yeah.
contained below,
Right.
4%.
Right. They can deal with that number. I mean, we had 8% for years and years, and tech stocks did great. Remember?
Yeah, but there's a whole generation of people
I know.
who don't remember that.
I know. Tell me about it. Look at the world. Generation is nuts.
Anyway, let's talk about what the CPI report could mean for the Fed's next interest rate decision later this month. Joining us is Roger Ferguson, the former vice chairman of the Federal Reserve, former CEO of TIAA, and a CNBC contributor. Roger, good morning to you. Always good to see you. The markets are giving the Fed a free pass for 25. Does this change anything?
Certainly, I think the market is right. The 25 in the upcoming meeting has been well telegraphed, and I don't think this changes anything. Obviously, it puts into question a bit more whether or not the September meeting is as live as we might think. There'll be a great deal of data between now and then, and there'll also be the Jackson Hole conference, so we'll hear more. But I think the market is right, 25 upcoming, and then September, I think let's wait and see. I wouldn't take it off the table at all just because of this one report, however.
Yeah. Do you think, given the rise that we've seen, in stocks in general, in tech stocks particularly, the larger mega cap stocks, some of the speculative names, do you think that concerns the Fed? Do you think that factors in that what they do is not working to dampen asset prices in this arena?
And I don't think they're focused on a specific sector. So the tech stock being up, I don't think is something that comes across at the FOMC table. As you well know, they do talk about something called the wealth effect and financial conditions. And so continuing strength in the equity markets certainly comes into play because it creates forward momentum for consumers and investors. It, in some small way, loosens what's called financial conditions. But I don't think they're fundamentally targeting equity markets at all. They're looking at those inflation numbers and trying to understand what's driving that. And some of that is very much more about wages, which I think are much more focused on than the valuations in equity markets right now.
Well, at least the initial market reaction, Roger, indicates that markets for now are pleased. Markets for now believe that the Fed may be at bay. And as you mentioned, September may not be as live, maybe even November. Do you think that's the right takeaway here, that it looks like what the Fed has done, like maybe they actually stuck the landing? Maybe that's an increasing possibility that there is that soft landing.
Look, I think there's an increasing possibility that soft landing, which is a very positive thing. Fortunately, we still see forward momentum in many sectors. However, I think it's really too early to declare that as a done deal because, as the Fed itself has said, much of the work that they've done has not yet shown up in markets. So we haven't actually seen the full impact of the increases in interest rates thus far. And there are some sectors that are weak that historically have spilled over into the broader economy. So think about the real estate sector. And the final point to note here is, if we are fortunate enough to have a soft landing, it would be, I think the second or third out of 11 or 12 attempts the Fed has had to do that. So too early to say soft landing. Certain positive news that soft landing possibilities perhaps have increased.
If you're, excuse me, Roger, if you're still on the Fed and you were entitled to a dot, I'm just wondering where you would stand in terms of how you see the rate hike trajectory given this latest piece of data and what you are seeing yourself in the economy.
So what I'm seeing in the economy is really very mixed, with some sectors that are more interest sensitive and struggling a bit more than others. I think I would, based on this number, recognize that September really would be a time to take a close look. Wouldn't take the 25 basis points off the table at all just yet, based on one number, because, and we've heard President Daley mention this the other day, I think they are now in what they would describe as a risk management approach. And I still believe they think, the vast majority of them, that the risk of stopping the hikes too early is greater than the risk of continuing and going maybe one too many. And so I think that's why September is very much on the table, and we should not in any sense think that they are done at this stage. I think at least September is a real possibility.
Roger, thank you. Nice to see you, Roger Ferguson. Coming up, what to watch ahead of the opening bell on Wall Street and following the new CPI report. Futures right now still holding on to gains, although off the best levels. NASDAQ looking to add 140 at the open. S&P looked to be higher by 30. Stay tuned. You're watching Squawk Box on CNBC.
Bitcoin pulling back a little bit here. Actually, everything is pulling back a little bit. Bitcoin, SPY, NASDAQ.
We have a nice cash position because we are
gold.
Earning now on that, and we're looking for the potential that we could see some weakness in the equities in the second half of this year.
I got to say, Tom, I'm looking at Bespoke Investment. They put out a report saying that at the headline level, there have only been 2 stronger than expected CPI readings in the last year, which is the fewest in a 12-month period going back to November 2019. On a core basis, just 3 stronger than expected monthly CPI readings. That has been the fewest since November 2020. There is a sense that Wall Street doesn't have as much faith in the disinflation as is actually coming through in the numbers.
This is really well timed that you bring this up, because Dr. Dudley alluded
bond
to
yields
that
are
when
pushing
he did
back
his
up.
Newtonian calculus in English, where we talk about the first derivative, the second
That's
derivative.
probably why
you make jokes particularly if you had a high
you see
hangover
assets
from course 3-2 light.
pulling back
You'd make
here.
a joke about the third derivative or the fourth derivative. But all of this anecdotal evidence leads to some form of vectors which say the agony of this inflation is over. Then the debate begins.
From an investment perspective, Megan, is it time to get out of cash, maybe not go into riskier assets, but lock in yields at a higher
That's what
level
David Kelly
if
said.
we are seeing inflation come in?
Yes, and we actually started to do that recently as well. We moved our duration of our fixed income investments out a little bit.
Gold was at
Not-
about
not
20.
significantly long at this point, because I
It's
still do
given
think there
back
is that
half
uncertainty around the
of
Fed.
the gains.
Yes, it looks like they may be able to be done in June. In July. But when it comes to rate cuts, when are they really coming in? And we don't think that's the story until 2024. So it's not a rush to run into the long-term yields at this point.
Futures are still
but we do
holding a
think
little
you
bit
should
here.
Move out some of those shorter durations into more of an intermediate duration.
Megan, thank you so much. Megan Hardiman with Verdant's Capital Advisors. Today, I'm going to call it a sustained reaction here. Yeah, there's a little bit of a pullback, and we'll show the charts on TV and discuss them on radio. But the bottom line is clearly off of the enthusiasms of Tuesday afternoon into a Wednesday where I would suggest the disinflationary zeitgeist got it right, Lisa.
Absolutely.
You've got a tangible move here. I'm looking at the levels. I got 4,500 on SPX futures, 34.6 on the Dow. That's 34,600, Lisa, on the Dow. And the NASDAQ 100 to be rebalanced here, up 0.9%. Rounded up 15,400 on the NASDAQ. I'm in triple leverage.
Also, guys, gotta remember, have to remember that
Markets are partying right now. They're excited about disinflation.
we are not
and the
done
data
here.
certainly suggests any way you slice it.
We'll
it
still
is
have
inflation going lower.
jobless claims tomorrow
putting out
morning.
formally of
We
Harvard,
have
Harvard, I should say.
PPI
But
tomorrow
even the
morning, core
super core
PPI.
data the Fed looks at, which includes
On Friday,
which
we'll
excludes
have
energy,
consumer
shelter,
sentiment
used cars, also
and
coming in dramatically.
import price
Any way you
index.
slice it, it says
So
the
we'll
same
still got a lot
picture,
of
the same story, Tom.
data
which is
coming,
a lesser
I should say at the
inflationary
same time as
backdrop.
I did.
Yeah, and it may be
Coming out this
transitory.
week.
That's certainly what we heard from Bill Dudley. We need to say
We'll see, because we still have to wait on data coming up. I mean, there is this lag effect that we've been talking about in terms of all the Fed hikes and what that's going to mean to the economy down the road. But for now, it is soft landing. The Atlanta Fed GDP now is at 2.3%. And I think all of this is going to translate into a little bit better on the earnings side of things. And this broadening that we've seen in the marketplace is much more healthy than what we had seen in the first half of the year.
Well, why fight it? Why not buy the Magnificent Seven if we're almost done raising rates? I mean, they're great companies, great growth, and there's momentum.
Yeah, I think you certainly can own some of them, but I think the valuations are not exactly cheap, and they're not exactly undiscovered. So I'm looking for other parts of the market where there really is value out there and where I think the expectations are really low.
Okay, so what would you be dabbling in today?
Yeah, so I mean, this one is really ugly. It's 3M. You know, you guys have talked about the industrials and how they've actually done quite well. Well, 3M has not done that well. It's down 15% on the year, and it trades at 12 times earnings. Joe, there are 0 buys on this stock from the sell side, and that is very interesting to me. And I'm sure that investors on the buy side certainly don't own it as well. But look, they're making progress on the water contamination settlements. There's more that they have to do, but that was good news. It was less than expected in terms of the dollar amount, and it was more comprehensive. We still have to get through the earplugs issue too, and settlements there. However, I think that once you start doing settlements, history suggests that the stock starts to rebound. If you look at Bayer and Monsanto, that's exactly what happened. And so they also have a restructuring, and then they have a spin of their healthcare business later on this year or maybe early next year. So I actually think that that's positive, and I think, again, kind of off the radar screen.
Do you have a couple more, and we have some time?
Yes, we have American Express is one that trades at 12 times forward estimates. Their long-term growth rate for earnings is 15%, total revenues of 10%. And I like their mix. Their mix is 80% of their revenues are fee-based, and 20% is net interest income. I don't really want to have exposure that much to net interest income because we know it's going to be weak this quarter, given where the yield curve is at. So I like the mix. I like their size and scale, especially with the affluent consumer and small, medium-sized businesses, and the return to travel and the return to business travel. So I like this one. It's up 18% on the year, but I do still like it. I think the valuation makes a lot of sense.
All right, I want to do one thing before we go and leave today. So that's going to be it, Steph. But thanks for the quick analysis. 3M and American Express. We will.
Thanks, Joe.
Maybe that's going to appear on Fast Money later. Maybe that'll be
at 5 o'clock.
At 5 o'clock,
perhaps
Eastern Time. Another reminder: don't miss an exclusive interview with Disney CEO Bob Iger tomorrow at 8 a.m. Eastern Time, right here on Squawk Box, from Allen and Company Sun Valley Media Conference, conducted by Peabody award-winning journalist David Faber. How's that, David? He asked me to. No, he didn't. I came up with that. I'll see you Friday.
See you Friday. I'll see you tonight.
All right.
At
Kelly tomorrow. Make sure she only has one name. Make sure.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Meantime, the bulls get their wish as June CPI comes in cool. Lowest monthly core in more than 2 years. Yields are dropping 2-year near 4.75 as a second rate hike this year is now in question. Our roadmap begins with that print. Inflation falling to its lowest annual rate in more than 2 years as well. Plus, game on for Microsoft after a judge rules the company can close its deal to buy Activision. And Domino's shares are surging, leading the S&P in the pre-market, announcing this new partnership delivery with Uber. Let's begin, though, with market reaction to CPI. As we said, coming in lighter than expected, Jim. Airfares down 8, used cars down 0.5.
Well, there's a lot of oddities. I mean, there's a couple of real wins that people aren't thinking about. You've got, you definitely have the used cars, very good, but shelter's down a little bit. And what's interesting is what's up is almost, I don't want to say it's meaningless, but the bakery products, I mean, you can easily trade down on that, right? Fresh whole chicken. So, I mean, switch over to beef.
Eggs down 7.
Yep. Yeah, I mean, sugar and sweets, well, good. We should have less of those anyway. The ones that are up, I am telling you, are going our way too. Because there are things that, frankly, are not, if you really got to go granular on this, Pal's winning. Because the things that are up are not nearly as important as the things that are down. We still have to worry about wages. I'm doing a lot of work on wages, and it's not good. IRA, infrastructure, number of plants being built, battery plants, those are not going his way. So we're going to see a plethora of new jobs created that we're really not ready for. But when it comes to the actual empirical data, I mean, like, other than Twinkies, we're in good shape.
Yeah. Well, you mentioned wages. Real average hourly earnings, Jim, June to June, now up better than 1%, is going to give some tailwind to the consumer who's going to find that things, I mean, inflation is softer than wages right now.
Yeah. I mean, I think it's just, there's some real wins here. Look, I mean, and the ones, again, that aren't so good, I mean, clocks. I mean, hey, who needs clocks? What's the point of a clock?
Maybe that's part of the issue.
Maybe they're just, like, talking about some antediluvian clock. And then we have, you know, in jewelry and watches, and I just think that's Apple Watch. So look, I know people are saying, Jim, you're being facetious. No, I'm actually being empirical. The numbers are very good. And right now, if you don't think Pal's winning on the details, I really think you should just get the page after page of what matters. But the big one is used cars. And we saw that coming with Manheim. And that is right in the sweet spot of America.
Yeah,
so.
And a lot of discussion how it's going to feed through into July's print as well.
Yeah.
That said, then why are people still talking about next week as a given?
Well, I think you have to talk about next week as a given because we are not going to see any ability to keep wages down when we have 3 states, Tennessee, Kentucky, and Louisiana, that are in a level of wanting to put up factories that they could distort the whole darn country. The number of jobs that are open because of IRA, because of chips, is so extraordinary that it's just inflationary per se. And it's really, I mean, I've been putting together the actual numbers of jobs that are required for windmills, just for pipes from West Virginia, for all the different natural gas liquids, for LNG. It's insane. So they have to. Some of these projects can't be stopped by the Fed, but the wage inflation is just going to be enormous. So I don't think it's wrong. I think Jamie Dimon has made some points today when he talks about having to go up. But it all has to do not with what we're seeing in the CPI, but what could be in the pipe for next year, given the fact that there's going to be such wage inflation caused by the federal government.
Jim mentions Dimon's comments to The Economist, talked about a bunch of different areas, bank mergers, but clearly his ongoing belief that
Lucid produced 2,173 cars in Q2.
Yes, he has. He did it with me when he was in Philadelphia. How are you going to get
moving down
baby
pre-market right now,
cashier person
down about
to
1%.
to spot well at a liquefied natural gas plant like the 2 that are coming? How do you get the people who are being laid off at Party City engaged in how to make a windmill in Kentucky? I just don't. The job mismatch is so bad in this country that the Fed has to take notice that the whole re-education of the workforce
down about 2% now.
So you're talking about job mobility, in other words,
exactly.
Right? We haven't heard Powell sort of decry this industrial policy. We hasn't come out and said, look, guys, we're trying to do something over here. You're working against us.
Well, I think the money's already been, it's going to the states. The states, if you take a look at what a Jacobs is saying, a big general contractor, AECom, they do the actual building, and it's just humongous, and it's all concentrated. You know, Micron's trying to find, they say 2,000 people to build $100 billion worth of plant.
Listen, guys. According to Tom Lee, the markets could move 100. Well, SPX, okay, could move 100 points today. 100 points, and if we open where we are right now, there's good opportunities here. We're only up about 30, 35, 30 points.
So you think
Good opportunities
still alive
today.
I think that when you start seeing the amount of
100
money that's
points
going
is
to come
crazy,
out
though.
in the next 3-4 months, it's just, I mean, you know, the states can't figure out how to do it. Mitch Landrieu is the infrastructure czar. I mean, he doesn't know how to do it.
Right.
No one knows how to spend all the money that they did. You know, a lot of people feel like the state should give some of the money back. Highly unlikely. And we're not going to rebuild I-95 in 2 weeks like they did in Philadelphia.
That was a one-off, for
Right.
sure.
That was a one-off.
So does that mean that the ebullience among the bulls today is overstated?
Yes, absolutely. Because like we may look at the price of fish and decide, you know what, it's time to go buy Gorton's. But when I look at what's going to happen in terms of wages, I just say Kentucky, Tennessee. I mean, you're going to see a level of individual state inflation that we're going to have to start looking at. And that's why these numbers, which of course don't include homes, they took those out in 1983 in order to make the CPI look good, we're going to have to reinstate some by state. Now, they do have some geography here that's not bad, but you're going to see some states have a dramatic increase in wages and a dramatic increase in, therefore, services. Because a lot of the places that they're building don't have anything around them. It's all green field. So I just think reclassify, retrain. Now, why no one's talking about this, I just don't know. I think it's because it's too granular for the.
Avago is ripping, man. This can hit 820 by the end of the week. 820. Currently at 893. I mean 920. It's currently at 893.
And we got to get them trained in the next 18
Can hit
months.
all-time high here.
Because this money's there. So I just think these numbers look very good in terms of what's going on with the consumer. But when you see what's going on with wages because of the IRA and because of the CHIPS Act, you're just going to see, well, wait a second, where are all these people?
Well, maybe that is a useful tailwind given that Johnson Red Book comps are going negative. Deloitte sees back to school going negative this fall.
The back to school,
for the first time in 9 years.
That was an amazing piece. The Deloitte piece, I want to point this out, is that every year the price of going back to school increases. So, you know, every year you go to Bed Bath & Beyond, buy the really bad stuff because your kids don't know the difference. No more.
Well, the inflation on back-to-school supplies has been insane.
It's been horrible. Right. I mean, it's been horrible. I think that Walmart is your last saving grace to be able to help. And TJX, which got a huge upgrade today. TJX is where you go.
Loop goes to buy. They were at 75. They go to 95 on TJX.
One of the secrets of TJX, by the way, a lot of undercover former police people in the aisles who, instead of just letting you walk out, like I once saw a person walk out of Banana Republic with 3 sweaters on a hot day, I demanded to pay. I was an outlier.
Yeah.
But when you go to TJX and you're in that second sweater, there's someone comes up to you and says, take that off. That's the smart way to do it. Why won't anyone else adopt?
Baba finally breaking that $94 or 94 point resistance. This could hit 98. Kava up 4%. Wow, things are up nicely here. Ooh, Melly. This thing was down about 8% the other day, and it's mostly gotten back all that it gave, all that it has given. It's a nice move here in Melly. Nice move here on Snow, Tesla. Everything's up pretty nice. I'm going ahead and end it here, guys. Trade responsibly. Only trade what you